because of the, was it 5,000 people they fired, and 2 million fictitious accounts that they basically manufactured. John Stump is now gone, who was a charismatic leader for the company. There has been talk about people pulling deposits out of the bank. I don't know if anybody's done any estimated EPS projections what the impact on the bank would be due to this, which just happened. So we're going to go from a fairly simple valuation on JP Morgan to a little bit more complex one because of the most recent events that have occurred with Wells Fargo. Warren Buffett has not liquidated his position, although a lot of the pension funds and endowments have basically freezed them from underwriting their securities. They've also freezed the assets under management and are probably looking for other advisors to basically take over from Wells Fargo because of the egregious violations of ethics and corporate policy that they did. So this one's going to be a little bit harder to do, but let's go for it. So what's the first model that we're going to use to determine the value? And the easiest one to do right now is just do the current stock price, because basically the current stock price reflects all of the information, both insider information, all information that's available in the market, along with all historical information, is currently reflected in the current stock price. So what I would want to know is, what is the current stock price? Somebody give me the current stock price.
52.82.
What is it?
52 and 82 cents.
Okay. Can you give me a 52-week high? 52.98. That was the 52-week high.
56, 26, 52-week high.
56, 26. Okay. And then can you give me, because this is going to be a resistance, right? And then can you give me a low?
43, 55.
So this is for support. How much was it? I'm sorry.
43, 55.
3, 55. And can you give me, is there any kind of slope to it, where we can do a projection out, a year, and try to figure out what a target price would look like? Anybody give me an estimated target price, just based on slope? Or is it in a downward trend? Are we going to not do an upward trend to get the target price? We do a downward trend to get the target price. Any in the technical data on the price charts?
It was going down, but over the last few days, it's like kind of spiked. So it went from being pretty low to just up.
And from that chart right there, is that the correct resistance and support?
Yeah, this is for the last month.
Okay, can anybody go back 5 years? And show me a chart. Joanne's got one there. You got it.
From the lowest point,
Yeah.
I think it is like 29.41.
So $30. How long ago was that?
5 years ago.
5-year low. Can you, from that 5-year chart, can you do just a straight line trend projection out to where you think the stock price could go over the next year? It's currently at 52. Could it hit 62? 62?
Yeah.
All right. So that just kind of gives us a quick and dirty idea from a technical standpoint. What the stock price is ranged, it's high, it's low, it's resistance, it's support, and just a trended target. Do firms that experience negative news recover in the long run? Do companies that have experienced negative news recover in the long run? Yeah, they probably do. They get rid of the CEO, restructure the board, fire a bunch of people, bring new people in, basically repair their credibility their shareholders and their customers. So yeah, it can be definitely done. So there might be, over the near to medium term, maybe they'll go through some problems, but in longer term, Wells Fargo may continue and probably will continue to be one of the top five banks, the top competitors. Okay, so what's the first evaluation methodology that we're going to use?
Perpetuity?
We're going to use perpetuity. Do we have any trended EPS? How far can we go back?
2006?
Or you can go, can anybody go back any further than that? Or is that as far as we can go? Okay, so 2006, can anybody go back any further than 2006?
1972.
No, I don't want to go back. You want to get like a couple cycles in there, right? You're going to see the percentage changes in EPS were over the different couple cycles. Are you going to start feeding me some numbers?
Actually, I will try to
Okay. What did you come up with on EPS for 2005? Okay. Okay, let's start there.
2.47,
7,
2.38,
8,
0.70,
0.70, okay?
yes,
Okay.
1.75,
5,
2.21,
2.21,
2.82,
2,
2.36,
6,
3.89,
8, 9,
4.10,
0,
4.12,
2.
and then currently it says 4.10.
Is it consistent for companies to be able to manage their earnings expectations, their earnings growth expectations? Is it important for a firm to be able to grow out their earnings per share at a constant rate into the future? Yeah, because it's going to basically guide the market to be able to say, hey, we've been able to grow our earnings per share at 2 to 3% per year over the last 10 years.
Does it make a difference if we use basic versus diluted EPS?
I like to use the basic because the diluted may give us numbers that are a little bit underestimated,
Okay.
depending on the amount of shares, potential dilution. And if you dilute the shares, is that going to affect the cash flow?
Okay, because I think on Morningstar those might be the diluted EPS numbers.
So you need to verify that.
Yeah, those are the diluted.
These are diluted?
Yeah.
Okay, so can you give me undiluted?
I can only find the last 5 years. I can't find the full 10.
Okay. Anybody else?
Are they called basic? Is that what it is?
Yeah, that was the other one.
We can run it with it. We can run it at basic. We just need to be at diluted. We just need to make them out. Okay. At the end of the day, it's probably not going to be material. But again, I like to use near free cash flow, which is going to be the undiluted.
Okay.
Because once you do diluted, it just adds in another accounting adjustment, which could affect the growth rates.
Okay.
But if you can get, does anybody have any undiluted? Or do I move forward with diluted?
I think you can move forward. I just wanted to make note that it was diluted.
All right, so let's go ahead and do the percentage changes. Okay, so can you give me the percentage changes between these per year? Can you do the calculations and then do the percentage changes? Anybody have any 2017 estimates or 2016? Are you guys doing the percentage change calculations? Need some kind of time series.
first one's
What was happening in 2001, 2, and 3? What was happening in 2001, 2, and 3?
Wasn't it just like growing very slowly, but then the crash came like?
Yeah, what years did, when was the recession?
03 and 04.
2000 what?
Well, 03 and 04, there was a small size effect.
2006.
Yeah, it's 2001, 2, and 3. So was there a recession here? Recovery? Peak? All the markets peak in
Yeah.
67? What was happening in 08, 09?
Recession.
What about 10, 11, 12, 13, 14, 15?
Recovery.
Recovery. That's basically peak. Probably mature peak again. Maybe even decline. Maybe. You see how Donnie does? See how Donnie does? Okay, so can you give me the percentage changes, please, so I can get an idea? Growth rate potential on earnings per share. 0.6. How much? Negative 70.
The first one's negative too.
This is negative 3.6. Negative 70. Does that make sense?
Yeah.
That would be negative. This was really not a fun time to be doing this exercise. This was really depressing. When we were doing this exercise in 08, 09, it was horrible. Okay, and then what's this? How much? 150?
Yeah.
150? Is everybody checking? these
Yeah.
two?
Yes. 150.
All right, and then what about between 9 and 10? And between 10 and 11? Then between 11 and 12? And then between 12 and 13? 16? And then between 13 and 14? And then between 14 and 15? And then do we have any estimates on 16? Any estimates on 16? Are you hearing about anything? Or are there any analysts that are saying we're going to project, because of the situation that we're taking our earnings expectations down for this year and next year? Do you think they'll, Wells Fargo will have an impact on their fourth quarter earnings and what's happened? Probably. And then 17, 18, 19, 20, 21, will have to, they can repair their damage. They may actually be able to gain their market share back and be off the probation lists for a lot of these endowments and stuff like that. So you'll probably see impairment in 16, definitely 17, 2018. If they get their stuff together, will be the last of the 2 years that they will be put on probation by a lot of these endowments in the state of California. But they won't let Wells Fargo participate in underwriting. So obviously that. And then we have the 2019. Is that about as far as we can? 1, 2, 3, 4, 86. Alright. So, anybody find any updated diluted earnings per share estimates for Wells Fargo for the rest of this year? Be on your computer, searching the internet, looking for information, looking for S&P, looking for Morningstar, looking for Valley, looking for Morgan Stanley analysts, well, Goldman Sachs, I think Goldman Sachs analysts came out with some estimates on EPS.
Barron's lowered the EPS from 3.88 estimate
What
to
is it?
3.69.
Yeah, but we're getting 4.
Three signatures, well,
I don't know where you're getting the 2. Maybe they're taking $2 off the 4. 'Cause it looks like it's around 4.
No, this is for 2016.
When was that produced? When was that published?
Published
Who published it?
July 18th,
Uh,
2016.
July 16th? July 2016? Too late. I need stuff like now. Right, there's too much that's been going on, not only regulatorily, we have a new president, also analysts are probably updating their earnings expectations, adjustments. And we just finished and we just finished a week, so I bet there's analysts out there that have been cranking through the numbers, trying to come up with some estimates for 2016 and 17. I mean, couldn't you just ballpark what it is? Couldn't you guess what it is? I mean, couldn't you guess what it is? You know what it isn't. It's gonna be 5%,
No,
6%,
no.
19?
It's gonna be
24,
probably
27?
negative something.
It's probably gonna be negative something, right? Or maybe still around here, because when was the announcement for the, when did they get busted? When was the announcement that basically,
Isn't it September or October?
so January, March, April, May, June, July, October, July, August, September. So you basically have, what, 3 months of unimpaired, 3/4 of unimpaired news, right? Because if it came out in August, right, it didn't really impact the first 2 quarters, right? September, October, November. So it probably wasn't even reflected in the October, September numbers. It'll definitely be in the 4th quarter numbers. So you only have 1 quarter that's probably gonna show earnings impairment. And you have 3 probably pretty good quarters. But still, the EPS was already decelerating before that, right, in 2015. You can see the deceleration. So it was probably decelerating into 2016, and you got the announcement in August, right? So the 4th quarter is not gonna be very good, right? It's probably gonna be hurt, they're gonna take charge-offs, they're gonna have to do a bunch of stuff. So what's the probability that the earnings per share estimate for 2016 is gonna be positive?
Not very.
Probably low. So what do you wanna do? Has anybody seen any information in any analysis based on earnings expectations for 2016 in the financial press?
NASDAQ has a December 2016 EPS of 4.04.
Okay, and then can you calculate the percentage change for that for me? Can you calculate the percentage difference for that?
So at 2%.
Negative 2%? Do you wanna use that, or do you wanna do more research?
I got the same thing from Wall Street Journal. It said
Okay.
4.04.
Okay, so NASDAQ, Wall Street Journal,
And Morningstar is like 4.03, so it's very close.
okay. Is that enough evidence for you guys?
Yeah.
Okay. Anybody have an opinion of more or less than this adjustment to the EPS? No? Yes? No? Last chance? No? Okay, we'll use it. All right, so now what do we do? What about, next year? We have 12 months. Can they do it?
NASDAQ says 4.08.
8, basically flat. Because they're gonna get hammered next year, aren't they? Yeah, they've already, I mean, a lot of these endowments, a lot of these state municipalities have basically put them on, probation to basically underwrite their securities. People are taking deposits out of the bank. They probably have some liquidity issues. Because if deposits are leaving, they're gonna have to sell off some marketable securities. Right, so there's gonna be some impairment. So you tell me, what do you think they're gonna do for 2017? I'm looking for a projection. Now, it's easy to be able to use somebody else's numbers, but it's more important to come up with your own projections. So do you think that EPS is gonna grow a little bit next year?
Yes.
Where the worst has probably happened in here in probably the first 2 quarters. 2017, they'll come out with a maybe rebranding of their communications with the new CEO and some new chief executive officers and statements by the board on how they're changing their internal ethics and blah, blah, blah. Do you think they'll probably do that all through next year, starting in January? Yep.
Then with Trump, doing all the things with the banks, will Wells benefit from that? And how
That's
is
a good point. That might actually overcompensate for some of the negatives that we've incurred. So do you want to stick with the, what do you want to use here? Because I'd rather have you come up with your numbers than use somebody else's numbers. So really, it just becomes a percentage plug. 1%, 2%, 0, I mean, what do you think? I mean, again, it was already at 0.5, and before that it was 5.4. So it's gotta be somewhere in between here or somewhere in between here. Again, it's up to you. How optimistic do you think Wells Fargo can be in repairing its damage and generating more interest?
1%?
Okay, anybody else?
1.5.
1.5? 1.5?
0.3.
0.3, 0, 1.5, 1,
1.5.
1.5. Let's be nice to Wells, okay? Let's be nice to Wells. 1.5. So what's 4.04 times 1.0? What is it? No, it's gonna be higher than the 4.04.
6.06.
No, it's not, it can't be that high. So what's 4.04 times 0.015?
4.1.
Okay. All right. But that's negative.
That's positive.
Oh, that's right. Okay, got it. Perfect. Okay, got it. Do we have 2017?
Yeah.
You want to start the valuations or do you want to finish the projections? You know, just since we're already on a troll, okay. So what do you think the growth rates will be over the next 5 years? So really, it's all down in here, right, at this point. These are the projections we need to come up with. And you gotta, and here's, you know what it isn't, right? We're not coming out of a recession, are we? We're not coming out, we're not going into a recession, are we? Probably not. So really the best period, probably someplace in the middle. As, you know, probabilistic growth rates. So what do you think Walls can do? From 17 to 18. You think they're still gonna get hammered, or do you think they're gonna benefit?
Gonna benefit.
They're probably still gonna benefit.
Yeah.
So what growth rate do you think you want to use? And again, remember, when you go negative like this, you're gonna get a positive pop at some point. Because your earnings are gonna be driven down, you're gonna take the charge-offs, the accounting charge-offs, you're probably gonna throw everything into the charge-off that you can to clean up your balance sheet and your income statement, and just throw all the junk in there now, get a clean slate, and take advantage of the negatives. So you can show really good EPS growth rates coming out of it. Once things start to recover, or you start to, your brand starts to recover, you're gonna get probably a pop at some point of a pretty high rate, because you charged everything off. And this might not even be a large enough charge-off for you, actually. I mean, the charge-off will probably come in here. But let's just keep going, we'll be close enough. So what do you think the growth rate will be between 2007 and 2018?
6%.
Okay, I need other input. You're the data analytics team, you're the financial security analysts in the firm. I need to have consensus.
7%.
7, 6,
2.
2,
5.
5,
5.
5,
That's a 6.
6.
5.
So 1.05, so it's $4.10 times 1.05.
4.3.
3, and then what about between 18 and 19? And probation will be over, but we'll be later in the cycle, right? We'll be on an economic stimulus in here to the fiscal policy. Donnie gets his way. And then who knows, what's gonna be happening out here, but we know that the growth rates probably could increase in here and here. Will probably be diluted down over in here. So what do you think between 18 and 19? Well, they did, 2014, they did 5.4, in 2013, which was really the primo coming out of the recession. 16 was kind of normality. So what do you think, 18, 19? And the fiscal stimulus will probably set in around here and here, if he gets what he wants, which will mitigate the decline. So what do you think?
7.
Okay, I got a 7,
6.
6, 6, 6, 6, 7. 1.065. I'll do consensus. So what's $4.30 times 1.065?
4.6.
6, 5, okay. 19 and 20. 19 and 20.
6.
At some point, it's gonna have to go down, all the fiscal stimulus and all the, juice from all the write-offs and stuff like that are gonna start to dissipate.
4.
We got 4, we got 6, 4, 5, 5, 4, 6, 6,
4.
4. We'll do 4.5. Okay, so it's 4.6 times 1.045. What is it? Okay. And what about between 20 and 21?
3.
What's 4.8 times 1.03?
4.95.
4.95, is that right? Okay. And then what about 21 to 22?
4.
That's a little high, you usually don't come up.
2.
I mean, we're probably gonna be in a recession by then.
1.
Okay, I hear 2, I hear 1, 2, 2, 1, 1.05, sorry. 1.015. So what's 4.95 times 1.015?
5.02.
5.02. Do those look reasonable?
Yeah.
Okay, so let's do perpetuity. So we already got the 2017 estimate, which is 4.10. You gotta come up with a discount rate. Okay, so what's your expected return? Which, if you bought the stock, what would you want in return? If you're gonna buy Wells Fargo, what return would you require?
8%.
You got 8,
9.
9,
10.
8, 10. 0.08. Okay. So what's $4.10 divided by 0.08?
51.25.
51 point how much?
25.
What's the current stock?
52.82.
What is it?
52.82.
52.82. Current. I like to look at it right off of that. But don't get too enamored with perpetuity. It's extremely simplistic. Okay, so, and then what was the expected return on the market for the S&P 500 over the last 15 to 20 years? Between 8 and 10%, what do you want to use?
8. Let's
about the cost of the equity or expected return based on equity. What did we come up with our forward risk-free rate? What are we gonna use? Our projection on the 10-year treasury in a year from now? What did we use? What did we use for CAPM? Might as well be consistent between the two valuations.
3%.
2%. Okay. Can somebody go up and find me a beta on Wells Fargo and tell me what its rating is on its bonds? To give you an idea of the volatility, the rates of return on Wells Fargo stock compared to the S&P 500. Can you find me some betas?
It says 0.9.
What is it?
What I'm finding is 0.93 for the beta.
Anybody else have any inputs from any of the other research reports or research? What the data could be? Is Wells Fargo pretty big? How big's the company?
Pretty big.
Is it like
Almost 2 trillion in assets.
almost 2 trillion? Is that a big company?
Yeah.
Yeah, do you think the stock price would approximate the overall market being that large?
Yes.
You know, when these get bigger, their betas can go down. Is this around 1?
Yeah.
Okay, so the question becomes, what do you think? Do you think Wells Fargo stock will become more volatile compared to the S&P 500?
Yes.
Probably. So what would be the beta? Would the beta be higher or lower than 0.93?
Lower.
If the volatility
Higher.
in the stock becomes less than the overall index, what does the beta do? If the volatility in the stock becomes less than the market, what happens to the beta? When the risk of the stock becomes less than the market, what happens to the beta? When the risk of the
Gets bigger.
stock becomes less than the market, does the beta go up or down? When the company becomes less risky,
Oh, beta goes down.
does their beta go up or down? When the company becomes less risky, does their beta go up or down?
Should go down.
Goes down, exactly. Is the company gonna become less risky in the next year or two? Is the company gonna become less risky next year?
No.
Probably not, because you have a basic credibility issue going on. It's gonna hammer the frickin' stock. And the stock's already become more volatile in the overall market because of all the noise and announcements. There's a lot of uncertainty around the company. So do you think that the risk around the company is gonna be less or more next year?
More.
More. So is the beta gonna be less or more than it is today?
Less.
It's probably gonna be more. There's more risk. Is there gonna be more volatility in the stock market next year? With Trump coming in and all the uncertainty? Yes. Has there been increased volatility in the currency markets over the
Yep.
last week?
Oh, yeah.
Yes. Has there been more volatility in the bond market? Yes. Has there been more volatility in the stock market? Yes. Do you assume more or less volatility and risk next year than last year?
More.
More. So would the beta be higher or lower?
Higher.
Probably higher. What do you want to adjust it to?
1.5.
And that's way too high. Is the company over levered? What's its ratings? What's its capital structure? Is Wells Fargo an over levered bank? Is it over leveraged? Does it use a lot of debt? Does Wells Fargo use a lot of debt? What is the rating on the bonds? Just based on what you know, it's one of the top 5 banks in the industry. Do you think Wells Fargo has levered up its balance sheet?
Yeah.
You do.
Oh, no.
Do you really? These banks are extremely conservative. They are the top 5 banks. You need to read the industry research
No, they didn't.
reports. Okay? So they're not over levered. What's their capital structure?
They have 1 point.
No, their capital structure, not debt to equity ratio. How much debt do they use to finance their assets?
Morningstar 65.
What is it?
65.
65%
Yeah.
debt? Are you sure?
So Morningstar says.
Well, I don't know if I believe that. So you're saying it's 35, 65?
Yeah.
Can somebody verify that? Is that gonna give you an idea of how the company is leveraged? Is this company over leveraged? 65-35 just based on these leverage ratios? Is this company over levered? Is this company over levered? Okay. So how can the beta be 1.5 when it's conservative leverage? What's the rating on their bonds? What does Moody's and S&P give them as ratings for their bonds? Do you think they're going to be triple B rated bonds? Do you think they're going to be triple B? Do you think Wells Fargo bonds are going to be rated triple B?
No,
No.
they're
Are they
double
gonna
A.
be double B? No.
They're
B?
double A,
They're double A.
yeah.
Hey, where you at?
So they're one notch below institutional, super institutional grade. So they are institutional grade bonds. So is the company over leveraged?
No.
No. So you cannot justify a 1.5 beta because companies that are over leveraged have very high betas. Okay? But if there's going to be more market risk next year and there's going to be more company risk, do you think there's going to be more volatility in their stock price?
Yes.
Yes. So do you think their beta is going to stay at 0.93? No. So how would you adjust it?
0.97.
Okay, I got 1.97. Anybody else?
0.98,
What?
0.98,
Okay, I got 0.98.
1.1.
1.1.
1.
1.05.
5. Okay, so we have basically a range here. So what do you want to use?
1.
So 1 times, and what's the expected return on the market you want to use?
8.
8. And what's the risk-free rate?
3.
3. What's the market risk premium?
5.
What's the market risk premium?
5.
What's the market price of risk?
5%.
5.
5%.
Plus the risk-free rate, what do you get for cost of equity? 8.
Yeah.
Okay, we got another 8 there. Okay, let's do the WACC. So we have a cost of the equity, 8%. Can you verify the capital structure? Can you verify to me the capital structure? I've only got one input here. It says that their capital structure is 65% debt, 35% equity. Is that correct? I only have one data point. I got one person who gave me a data point. Can somebody else find some capital structures so we can get an idea of how to calculate the weighted average cost of capital, which will give us another discount rate? What do you think their cost of debt is? What did we come up with the cost of debt for JP Morgan? What do we use? What was it? No, what was the cost of the debt for JP Morgan? What did we come up with the cost of the debt to calculate the weighted average cost of capital? What cost of debt did we use for JP Morgan? What did we use?
10%.
No, we did not for the cost of the debt. We had the cost of equity was 10%. What was the cost of the
Oh,
debt?
58, 42.
What did we use? No, the cost of the debt, the yield to maturity on the debt. What was our estimate?
5%.
5%, okay, 5%. Now, what was the rating on the bonds for JP Morgan? No, it was A minus. A minus. Now, does Wells Fargo have a higher rating? So would their cost of capital be higher or lower than JP Morgan? If Wells Fargo has a higher rating, which means it's even higher quality, more safety,
Lower cost.
it's gonna have a lower cost of capital. Okay, so just based on what you know, what would be their cost of debt?
Lower.
It'd be lower. So what's lower than 5%?
3.
3? Do you think that Wells Fargo can issue debt at the same cost of capital as the federal government?
No.
So what is it?
4.
4,
4.5.
4.5? find the Wells Fargo debt bonds that are currently yielding out there or at issue, what their yield to maturities were, we're gonna have to use this because it would take too long to do it. Do you think we're gonna be close?
Yes,
Yep. Do you need to be super close?
no,
No, you just have to be close enough. All right, and then, has anybody verified or validated the capital structure?
I found the same thing on Morningstar, but I'm trying to
Okay.
find another source.
Okay, is it book or market? Can somebody start doing the calculations here for me? 8% times 0.35. And 4.5% times 0.65.
The first one is 0.028.
Point, is it 2.8%? Is that right? 8% times 0.35,
Yes.
okay? And what is 4.5% times 0.65? And again, we're not doing the tax shield on this one.
Okay, that's 2.9% and 3%.
9, and then what's the total? What's our WAC?
5.7%.
5.7 or 6%?
Yes.
Okay, is that lower than the cap M?
Yeah.
Okay, so you know you're in the ballpark. Okay, so have we run it yet at a 7%?
No, we haven't.
7, so what's $4.10 divided by 0.07?
$58.57.
yeah,
Now the question is on the sensitivities, are you gonna use 6%, 7%, 8%, or are you gonna use 7%, 8%, 9%? You have to determine the sensitivities now. What scenario are you gonna use for the sensitivities going forward in your evaluation methods?
7, 8, 9.
7, 8, 9? Now you got it. All right. Nobody's gonna give you a hard time on that. Okay, nobody's gonna give you a hard time. 6 is probably a little low, all right?
me and Des had a question about that a while ago, about the weighting, when you
Now,
have the
this-
two
these are
different,
sensitivities.
or the sensitivity?
These are called sensitivities.
Okay.
Those are not weights.
Okay,
We weight the ratios
uh-huh,
and we weight the valuations.
okay,
We don't weight, these are sensitivities, these are discount rate sensitivities.
alright,
So you have to decide, since you got a 6 over here on the WAC, do you use 6, 7, 8, or do you use 7, 8, 9? I mean, if you use 6, 0.06, what valuation do you get if you use 0.06? What's 0.06, what's 4.10 divided by 0.06? What value do you get?
68.3,
68.3, okay, and where's the current price?
5282.
What's the premium?
1.29,
So it's 29% premium, what you're telling me? Is that possible?
No.
Might be. Just be open to it. So, but you really have to decide, do you use 6, 7, 8 or 7, 8, 9? Do you want to be more conservative or do you want to be more aggressive in your sensitivities? Okay. You want to be conservative or aggressive?
Conservative.
Probably more conservative. Do you want to raise red flags
No.
in your analysis? So they're grilling you the questions? Or do you want to be more conservative? And the results basically be the same. Yeah, you're probably going to be more conservative. Okay. So we're going to use 7, 8, 9. Right? So we already have perpetuity, right? Do we run it at 9? No. So can you give me 4.10 divided by 0.09?
45.6.
So we have 45.6 at 9, we have 51.25 at 8, and we have 58.57 at 7. Which one do you want to use for perpetuity?
8,
do Gordon Grove. So you set up the grid, G, 10%, 2%, 2%. What's our discount rate sensitivities? We're gonna use
789.
8%, 9%. Okay, and then 7 minus 1 is what?
6.
6, and then 8 minus 1? 7, 9 minus 1, 8. Oh. And I'll let you do these for the 2 and the 3. Okay, but we'll just do this one. So we already know what 6 is, right? It's $68.30. Already run it at 7, it's $58.57. And we also ran it at 8, which is $51.25. Now remember, these numbers here are the same on the diagonal. So I'll be checking that pretty quickly. So what do you want to use? What discount growth rate scenario do you want to use? Well, this is a $2 trillion bank, we're pretty close. So you know EPS is not going to grow that at 2 and 3, but you do the analysis anyway. So what do you want to use? So which, we already know the growth rate scenario we're going to use. So what discount rate scenario are we going to use?
8.
Anybody have a, do you all agree? You want to use 8? 58, 57. And what's the premium on that? What's the current stop price? 52.82. What's the premium? So it's 58 divided by 58 and 57 cents divided by 52.82. So 11%.
11%, yeah.
Within the target range.
Yeah.
Okay, so let's do multiple. This is Gordon Road. G. This is opportunity. Okay, now let's do multiple. So what's the equation for multiple? What cash flow are we gonna use? What earnings per share are we gonna use?
8%.
No, the cash flow. 410. Okay. So we're gonna use the 410. Who do we multiply by? So give me some multiples. What's the current PE? For Wells Fargo, what's the current price earnings?
For 2016.
12.8,
Yes.
right? And this could also be what, 13 times, and it could probably also be 12 times? Right? Get some sensitivities.
Yeah.
Do we know, can we run the perpetuity, what did we decide, 0.08? What's that multiple, and then we're gonna use Gordon Growth, 0.07. What's that multiple? So what's 1 divided by 0.08 and 1 divided by 0.07? 1 divided by
divided by 0.07 is 14.3.
14. Okay, so this is basically 12, 13, and then we have 14 here. Okay. And then do we have any peer groups? We have city, B of A, Wells Fargo, we already got Wells Fargo. We have Goldman Sachs. Who else do we need? JP Morgan. So can you give me their multiples?
Bank
You
of
should already have them.
Yeah, Bank of America is 13.53.
So we already have that.
Goldman Sachs is 13.45.
Okay, we already got that.
Citibank is 11.67.
6.
Then who else?
JP Morgan.
13.34.
13.34. So it looks like to me 14 times, 13 times, 12 times. Do we need to go to 11?
We could.
I mean, this is 11.6,
Yeah.
and that's the worst performer of all.
Yeah.
So it really doesn't make sense that we go to 11. Does anybody give me 15?
No.
No. So we know it's not 15, and we know it's not 11. Right? So it's got to be between 13, 14, or 13 and 12.
So in our presentation, when we have to have the peer group, PE, like,
2015, 2016, 2017. You can add those three.
those have to be in the presentation.
Yeah. You gotta have the banks. You gotta give me the top 5 banks. And then you gotta give me the ratios. You gotta give me the multiples. So we can do the analysis. So you're gonna have to project out you have to estimate forward multiple for the peer group. You already know what 15 is. You already know what 16 is. Can you think creatively and project what you think the multiples are gonna be for 2017? Yeah. They're either gonna be the same, higher, or lower. You have to figure it out. Okay? But we know what the ranges are. So that's all we gotta do is you gotta tell me which one you think it is.
13.
Which one do you wanna use?
I said 13.
13?
I agree.
So 4.1, 4.1, 4.1. So what's 14 times 4.1?
57.4.
7.4. And what is 4.1 times 13?
53.3.
53.3. And what's 4.1 times 12?
49.2.
9.2. And you've already said you want 13.
Yeah.
So now you have the approach. What's the current stock price?
52.82.
52.82.
Yes.
And what's the premium? What is it? 53.3 divided by 52.82. What's the premium?
Like 1%. It's really
How much?
close. It's really close. Like 1%.
4%?
1.
1%? Is that right?
Yeah.
Can they do that? Is that strikeable?
Yeah.
Yeah. Okay. All right, now let's do DCF. So we already have the projections over here for the 5 years. So we can just use those. What discount rate are we going to use to discount the cash flows?
What do we say? 8?
Yep.
Get 7, 8, 9. basically have one divided by 0.08 over here is 12.5, so basically that's the 13. So what discount rate do you want to use?
8.
8. Okay. 0.081, 2, 8 to 3, 1.084, 1.085. Okay. You want to give me those discount factors? This is 1.17. It's 1.08 to the third. 1.08 to the
One
third.
point two five nine seven.
Just round up.
1.6.
Okay, and 1.08 to the fourth.
One point three six.
1.08 to the fifth.
47.
And then what do we do with the year 6 cash flow? What do we do with the year 6 cash flow?
Item to be right there.
Oh, is that what we do?
Grow it out over year.
We did.
Yeah.
Gordon growth is a good
You want to use Gordon growth?
terminal value.
You want to use that? You want to assume that the cash flows are going to grow out at a constant rate into the future, or do you want to assume that they're flat?
Flat.
Flat.
You want to be conservative?
Yes.
Okay, you don't want to use Gordon growth?
Actually, should we use Gordon growth for
No,
inflation?
that's up to you. You as the analyst have to decide, do you think that Wells Fargo can grow its earnings out forever at a constant rate, or you want to be conservative and just assume that they're flat?
I think we should use Gordon growth.
Okay, so what terminal discount rate would you use? What terminal discount rate would you use? What's your going in discount rate?
8.
Is 8%. Are you gonna use 8%?
No.
Is this where you add like illiquidity and like?
No, that's what we did up here for the cost of the debt.
Okay.
But the assumption is that, is there gonna be more risk in 6 years from now?
Yes.
Is the company gonna be older?
Yes.
What about in the next 20 years from now?
Yes.
Yep. Okay, so would you use the same discount rate as today? Or are things gonna be more risky in the future?
We riskier in the future.
Okay, so when you tack on some, yes, risk premium onto the going in discount rate to reflect additional risk in the future?
Yes.
Yep, so how many basis points?
200.
What? So you wanna go to 10?
Yeah.
Okay, and then what would be your growth rate assumption in which Wells Fargo could grow their earnings per share forever?
1%.
Because you're not gonna use, you're assuming the growth rate, right? If it was 0, you'd be perpetuity. 2% is way too high. You're gonna get really high numbers, so you're gonna use 1, which this becomes 0.09. So it's $5.02 divided by 0.09. And what are we trying to calculate here?
Terminal value.
The terminal value. So what is the terminal value? If we divide 5.02 by 0.09,
55.8.
$55 and what?
7.8.
Just 8? $55.80?
Yeah.
78.
78? 78 rounded out?
Yes.
80?
Yeah.
80.
Okay, so now what do we do with this?
Add it back to the last year.
Year 5 cash flow.
And what do we get? What's our last year in the holding period cash flow?
60.75.
What is it?
60.75.
60.75?
Yeah.
Is that correct?
Yeah.
Okay. So what's 60.75 divided by 1.47?
41.3.
41.3. And what is 4.8 divided by 1.36?
3.5.
Yeah.
3.5. And what is $4.60 divided by 1.26?
3.65.
3.65. is $4.30 divided by 1.17? 3.7. And what is $4.10 divided by 1.08?
3.8.
What is it?
3.8.
8.8?
3.8.
Oh, 3.8. Thank you. 3.8. So what is, do this right. Bring that down here. This will be DCF. And what is $41.30 plus $3.05 plus $3.65 plus $3.07 plus $3.08?
55 and 95 cents.
55.95.
Yeah.
Okay, and what's the current stock price?
52.82.
52.82. And what's the premium?
6%.
6%. Is that doable?
Yes.
Yeah, those are pretty good results. Okay, so the last thing you gotta do now is the weighting scenarios, right? And we'll just do one, right? And then we'll do the trades. Okay. So give me the perpetuity valuation. What did we come up with? What was the valuation for perpetuity?
51.25.
Yeah, 51.25. And then what do we get for Gordon Grove? 58, 57.
yeah.
There's a lot of numbers. At some point, it becomes Campbell's soup, right? Multiple, what did we come up with on the multiple? 53.30.
Yeah.
53.30, and then DCF.
55.95.
55.
55.95.
This is the weights.
Yeah, this is
Scenario 2, give me the weights.
10, 10, 30, and 50.
1.1, 0.3, 0.5, 0.
Yeah, that's, because of the concise, because of how like concise that's what he,
And then,
the DCF, like, it's so
can
specific.
you give me the weighted shares?
Like that. We made our own music.
Can you give me this is what?
5.125.
$5 and
1.3 rounded.
5, this is $5 and
8.57.
8.57, and then what's 30% of 53.30?
16.
What is it?
15.99.
9, and then what's $55.95 times 0.5?
27.97.
97, and then what's 27.97 plus 15.99 plus 5.57 plus 5.125, and round it up.
Yeah.
54.95, is that
Yes.
what everybody gets?
Yeah, that's what I got here.
And then what's the current stock price?
52.82.
52.82, and what's the premium?
4%.
Now the question becomes, is this a buy or hold? Is this a buy or a hold?
Buy.
You wanna make it a buy?
Yeah.
Buy.
Okay. So this is sometimes when they're so close to the current stock price, it would almost be a hold, but it's really up to you as the analyst to make that decision. So what you all come to consensus is you're gonna make a buy recommendation, because things could actually be better, right? Things could actually get better for these guys if they pull it together and they really take advantage of the regulation modification if they repair their brand.
When we do the recommendations, do we make it clear that we did, like, the terminal value with the estimate at the end? To be like, you should hold it for at least 5 years? Do we let them know
Yeah,
that?
this is the 5-year holding period.
So we let
The
them.
average holding period for a stock is 7.
Okay,
for retail investors, it's perpetuity, it's forever for institutional investors.
Okay.
But what we're doing is we're doing a 5-year holding period, because we can't do a 10, it would be too complex, and 3 is too low.
Okay.
So you may want to do this someday,
Uh-huh.
is, go ahead and project out the earnings per share out to 30 years, okay? And then run these discount factors. What happens is the discount factors get really, really big,
Yeah.
and the cash flows look like this over time. Let's say this is 2017 to whatever, 2050 or something.
Wow.
What happens is the cash flows go like this, and then they become a calculus, a isotope.
Uh-huh.
Anybody remember the isotope? Right, the isotope basically says that it's always going to be positive, but it's going to be infinitesimally small. So instead of going out 30 years, you truncate it to 5, and then the terminal value, when it does, the terminal value calculation captures that as the terminal value.
Is this how companies determine their life cycle? If they're like in the beginning or rising? Like if Apple were to do this for themselves till like 2070, is this how they determine?
You couldn't do it to 2070 because the discount factors would get too big.
But they could do it, right?
Yeah, they could do it. It's theoretically the exact same thing. So if I ran it out for 30 years, and this was, at some point in time, this is just way too small, this means nothing, right? It means nothing. So if you sum this up, this is going to be your terminal value. This is your TE. So it's basically discounted cash flow between 5 and in most cases it's around year 20. Anything beyond 20, it becomes too small, it's nothing. Because the discount factors are so large. So this discounted cash flows in here, the DCFs in here, equal the terminal value. Okay. So it's like, I don't need to go out 30 years. So let's just do a 5-year holding, 5-year holding period, calculate the terminal value, add that to the last year of the cash flow, and call it a day.
So when you make financial products, do you do this for others, like stocks? Do you do this for like Bank of America, and you put them all together, and then you
Yeah,
add
this
them
would
to
be the first step in building a portfolio,
Okay.
okay? Because I want to build a portfolio of stock, I would do this analysis to be able to select the companies.
And then
Okay.
with the premiums, do you add them up or do you average them? And is that how you get the like return premium for the portfolio?
No, I just calculate the premiums like this to be able to check to make sure that we can hit the target.
But what I'm saying is when the portfolio has a premium percentage, do you calculate that by adding?
Yeah, we're gonna
these?
calculate, based on these premiums,
Yeah.
will be an estimated I will calculate the expected return on the portfolio based on the premiums.
Okay.
Based on the premiums.
So the premiums are different from the return,
Well, the premiums are a return,
or the return?
are a return, not the return, a return, because I'm getting dividends from these companies too. I haven't even tacked in the dividend. So if I'm saying that the company's gonna go up, its share price is gonna go up 4% over the next year, and I get a 4% dividend yield from the company, my total annual return is gonna be 8%. I didn't even include the dividends in here.
So do you get that 4% from Wells for writing this?
This is just what you're getting based on selecting the security, doing a good job,
Just for putting it in your portfolio?
just for selecting it,
And putting it in your portfolio?
and then putting it in the portfolio, or buying it, or trading it, or do whatever it is. But this is pretty up. I mean, most people do 14. But Wells Fargo is a different bank. You gotta understand, it just got hammered.
But you yourself
That's why
getting,
it's so low.
but you yourself getting 8% is great, because that's what we wanted in the beginning anyway.
Yeah, so you're hitting your target.
Cool, yeah.
Okay, but the problem here is, remember, it's not JP Morgan. JP Morgan already went through its bashing in 2013 when the rogue trader basically impaired them with an $8 billion trading loss. Now Wells Fargo's going through it, and they're gonna have to calculate at some point, what the losses are from what they did, and then they'll probably figure that out and they'll charge it off, and it'll hit the EPS. So we've already kind of factored that EPS hit into 2016, but really into 2017. Because their earnings per share growth rates could be significantly higher than 5 or should be higher than 5. But it's taking charge-offs next year because the company got hammered. So let's do the trades. So we're gonna do a buy recommendation, so give me the trade recommendations. We're out of here.
Buy call options?
Give me the trades. Give me the stock trades first. Give me,
Buy,
I'm gonna buy it,
sell margin,
buy a margin. What else?
Right puts.
No,
buy calls,
buy calls,
right puts,
right buys. For how many trades?
15.
How many trades?
4.
4. Okay, and what about, does Wells Fargo make up a significant portion of financial service ETFs?
Yeah.
Can I find an ETF whose stock price and return is highly correlated to Wells?
Yeah.
Yep. And what would be the trades? Same. So, okay, for how many trades?
4.
Do you think Wells Fargo makes up a significant portion of financial services stock price indexes?
Yes,
Yep. So could I find an index?
S&P.
I could. I probably wouldn't use S&P because that's a broad market index. I want a specific financial services stock price index that just tracks the industry. Because obviously Wells Fargo makes up a huge portion of that index. So what would be my trades?
Buy forwards, futures,
My futures,
buy calls on forwards,
no,
or futures, sorry.
my calls, futures, and what else?
Right puts, futures,
Right puts, futures, for how many trades?
4.
4, and then a grand total.
12.
And then remember, when you list the trades, say buy Wells Fargo Bank stock, buy Wells Fargo Bank stock on margin, buy Wells Fargo Bank call options, right? Wells Fargo Bank put options. Buy financial services ETFs, buy financial services ETFs on margin, buy financial services calls, ETF calls, right? Financial services
Put.
ETF puts, and then buy financial services index futures, financial services index forwards. That should be the first one. Buy financial services index calls on futures, and then right. Financial services, puts on futures. Okay, so make sure you put in the financial services for the indexes and for the ETFs. Okay. Any questions? Okay, so you guys are in good shape for Wells Fargo. Okay, so if you can hit that.